Hi everyone, it's Shout with another video. Today, once again, I'm going to be talking about Alibaba. They released decent earnings today and the stock got 2% on a strong day for the market. This stock just doesn't want to go up. Since the high of October 2020, the stock is down 66% and is now under $300 billion in market cap. I think most of its problems, the delisting, the problems of the domestic government, are easily priced in at this point, and yet the stock still declines on wider market fears. I'm an Alibaba shareholder, and I've been adding slowly over the last since it hit 150 basically. And at these prices, while it's a relatively small position in my portfolio, I'm going to be scaling in much larger and betting quite big on this. I want to show you a couple of reasons why in the most recent earnings report, then look at the valuation of the company. So first of all, this is not the best quarter in the world. Essentially, Alibaba can be split into its Chinese e-commerce business, what I would call the legacy e-commerce business. That is still the core of its profit and the core of its revenue. 71% of total revenue in the most recent quarter, 70% of total revenue for the year. It's growing 22% year over year, which is reasonable. Only 7% for this quarter, so this is a weak quarter, don't get me wrong. Earnings down significantly from last year for a wide range of reasons. Cloud segment, slightly weaker than expected growth for this quarter at 20% because they lost TikTok as a customer, but for the full year, 27%. One of the main reasons I'm so bullish on Alibaba is because effectively the Chinese e-commerce business is trading at around 12 times free cash flow. Everything else is effectively discounted. 12 times free cash flow is an incredibly cheap valuation. Everything else is extremely discounted. The international commerce segment, which grew 32% year over year, 18% in a weak quarter. Everything here, away from the legacy business, the real growth prospects for Alibaba is severely discounted versus the wider market, which to me is crazy. Alibaba is crucially a tech company, and it's spending more on R&D for these businesses outside of its core businesses, and this is to be expected. Earnings are not going to be crazy every year. The cloud is not a cheap industry, but the potential here is huge. The headline for this quarter really is solid growth in revenue, not the best in the world, and increased spending. Of all of Alibaba's other business segments outside of its legacy business that are loss-making, by far my favourite is the cloud segment. By Alibaba's own future estimation, the total addressable market for the cloud computing market in China is going to 5x from 2020, which is obviously a couple of years ago, to 2025, from 0.2 trillion renminbi to 1.0 trillion Chinese yuan. That is absolutely crazy growth. For information, Chinese yuan or renminbi is roughly, it's 1 to 6 US dollars. So divide that by 6 for US dollars. Still crazy. Huge compound annual growth rate expected going forward. Tons of industries yet to move to cloud. Major potential for margin and revenue expansion with Alibaba's cloud service. The potential margins for Alibaba's cloud service are far above that you'd expect for e-commerce, as we see with the likes of Amazon Web Services, Azure and things like that. So there's huge potential for margin expansion for the wider business if Alibaba can get a decent amount of revenue from the cloud business. Another really bullish metric for me, the international user growth. The total net worth for Alibaba in annual active consumers is 1.28 billion, which is absolutely fantastic. The majority of this comes from its legacy and inverted commerce business, the Chinese commerce retail, which grew 15% year over year, which is quite nice growth if you ask me. Internationally, they grew much better, 37% year over year growth, now 300 million international users. These are the more faster growing e-commerce segments outside of its legacy business. This is really strong growth, especially at this scale. That's 16.3 million quarter over quarter net adds. Absolutely tremendous in my opinion, and really, really nice to see this strong network effect in other countries outside of China. Of course, the key reason why Alibaba is so attractive right now, aside from all of this, is its share price. The share price is $106, the lowest we've seen for many years, lowest since 2016, I believe. The company is significantly larger since then. Pretty much every metric is the lowest in Alibaba's history on the public markets. Price to earnings ratio of 15.2 and a forward P of 11.8 are both far below the S&P 500 average, indicating a significant discount to the average S&P 500 company, which of course, Alibaba's growth rate is far from average at 25% a year with strong tailwinds. Some of these numbers may be a little off because the earnings reports just came out, but for the majority they're going to change very little because the earnings were not bad enough that it would change these significantly. Price to free cash flow of just 9.6, PEG ratio of 0.69, where 1 is considered cheap. So many metrics here. You can look on the right hand side versus Alibaba's history. This is just about the cheapest it's ever been by these metrics. On the left hand side versus the industry, this is for the wider retail and e-commerce industry, so there's a lot going on here, but cheap nevertheless. I mean, 12 times forward earnings for a company that's going 25% a year with strong margins is absolutely dirt cheap. And of course, is part the market is overpriced in my opinion. The problems that Alibaba has with delisting fears, the struggling with earnings most recently, and the regulation from the Chinese government. I think these are far, far overly priced in my opinion, because it is much better than the average S&P 500 company, whereas the S&P trades around 24 times earnings, something like that right now. Absolutely crazy that this is essentially half that. Looking at the balance sheet for any potential red flags, cash debt ratio is actually pretty good here at 3.03. Alibaba has been spending and taking on debt to invest in these other businesses essentially outside of the core e-commerce. So this is not insane for Alibaba's history, but strong for the wider industry. Debt to EBITDA is strong at 0.94, showing the debt is relatively well covered. Almost score of 3.23 indicates the company is not at immediate risk of financial default, but it's not a particularly strong score. These numbers are good, not insane. Interest cover of 5.35 is quite weak. Debt to equity of 0.16 is quite good. Equity to assets of 0.56 is just okay. So these numbers are not the best for Alibaba's history, but decent nevertheless, strong for the industry. Margins, on the other hand, are absolutely excellent, and as some of the have shown some weakness recently versus Alibaba's previous record. Operating margin of 10.69 is very strong for e-commerce, and net margin of 15.28 is very, very strong for e-commerce. That means they take home 15.28 cents for every dollar of revenue. Return on equity percentage and return on assets percentage are both average in my opinion, pretty much where I would expect them to be for this type of company. As you can see from how Guru Focus has given this a 9 out of 10. For the industry, all these numbers are absolutely exceptional. Even if they're fairly weak for Alibaba's standards, this is to be expected because they're spending a lot of money in other areas, spending a lot of money on R&D, which is hitting the margin a bit. But nevertheless, absolutely excellent numbers. In my opinion, all companies are worth the sum of the future cash flows, so this is really the next logical step in the evaluation, is to a discounted cash flow analysis. In this case, I'm using earnings per share because there's just better data available here, and I think this is a relatively mature company. I think earnings per share is fine to use here. I've did two calculations, one using 10% earnings per share growth to be relatively conservative and to illustrate how cheap Alibaba is at the minute, and on the right hand side, 20% to be relatively optimistic. Revenue growth is much stronger than both of these estimates, as is earnings per share growth over the last 10 and 5 years. I would expect earnings per share to grow roughly in line with revenue. You also have to bear in mind that the company buys back stock regularly and has been doing so while the stock price is relatively depressed. The 10-year average earnings per share growth rate of 53% is obviously just a bit significantly too high, so I'm not going to do that. The 5-year earnings per share growth rate of 22.6% seems about right for me. This year's kind of a freak year, so I'm ignoring the 0.67% and putting a bit of faith in management. Revenue growth, 55% for 10 years, 45.5% for the last 5 years, and 48% this year. I would expect earnings per share to grow roughly in line with this. So again, while I think some people would say 20% earnings per share growth for the next 10 years is optimistic, I actually think this is relatively realistic if the company continues buying back stock as regularly as it is and growing earnings for the immediate future. At this estimation, it's approximately 1/3 of its fair value for the 20% growth rate. $106 stock price today, $293 fair value. That's a significant margin of safety, roughly three times upside. On the left-hand side, with a 10% earnings per share growth rate, both using 8% discount of the market, the same conditions. Still, $145 fair value, so that's roughly 40% upside from today's stock price of $106. Both significant margins of safeties. I think perhaps 10 for those who are conservative and believe that Alibaba is going to continue to spend a lot on its other bets, essentially, using like an alphabet term. On its other bets, its other segments, then 10% earnings per share growth rate is perhaps more realistic if you believe this. Even then, 40% upside, significant margin of safety from here, in my opinion. So in summary, I haven't really spoke about the problems with delisting, government regulation and things like that, because they've been spoke about so much. I think they are beyond priced in at this point. This is a company that is a third of what it was a year or so ago, and it is clearly not a third of a company. This was a nearly $1 trillion company that is now just $292 billion, trading at 15 times earnings, growing 25% a year easily with good margins, great tailwinds for many of its new business segments, huge total addressable market, and significant margin of safety based on my calculated fair values in both scenarios. I think this is a rare opportunity to buy a genuinely quality business still in growth mode for pennies on the dollar. It's absolutely not without risk. As I mentioned, delisting fears are real, although I think they're massively overblown. I do not think Alibaba is going to be delisted, but of course that's just my opinion. And the Chinese government regulation issues, I don't think it benefits the Chinese government or benefits Alibaba shareholders or anyone really for Alibaba to be forced to be delisted. It's a very different situation from Didi, which was a legitimate worry about
data sharing, essentially. I'm not concerned that Alibaba is going to be delisted in the short term. I think even if it was, there's significant margin of safety here and significant upside to alleviate the risk of this. And of course, as happened with Didi, it can be relisted on another exchange. Alibaba already has a dual listing. It's on the Hong Kong Stock Exchange, so there's a bit of insulation of risk there. I'm quite happy to be an Alibaba shareholder, and I'm going to be scaling up. Actually, I'm going to be taking a bit of a bet on Alibaba, increasing my portfolio allocation to around 2 or 3% of my portfolio now. Probably going to double that to around 6 or 7% because these prices I just can't turn down. But again, all this is my opinion, and none of it is financial advice. If you want financial advice, you should speak to a registered financial advisor, and of course do your own research, and comment down below your opinions on Alibaba, what you think going forward, and like and subscribe if you're enjoying the videos. I'll see you again.